Why dividends matter. When I show you this, you'll say that makes complete sense, and then you'll always recognize that dividends do matter in your investments. Absolutely. My man Ross from Prince Edward Island sent me a video by a guy named Ben Felix, who's a portfolio manager up in Canada someplace, who just recently did a video that said dividends are irrelevant, and I cannot disagree with that more. So let's dive into this. And if you're, I'm going to put this is going to be part of my retirement planning course that I'll sell here in probably 2 weeks when I'm done with it, maybe 3. I got a lot of videos on there, but I am making this one available to the general public because I think it's important. But if you're watching this through my retirement planning course, this is one of the few videos that are available for free on YouTube. So don't get worried that, hey, you're paying for stuff that's available out there for free. The vast majority of my retirement planning courses videos will not be available for free. So just FYI, and I appreciate you buying this. And even if you're watching this without my course, I appreciate you being here too. So let's start with the premise. First of all, we have a demand deposit account. That's a checking account. That's called a DDA. It's a checking account, demand deposit account. We got $1,000 in there. All right. So we're sitting around, we're saying, okay, we got $1,000. What should we do with this money? We're going to take 100 of that. It's called a debit. And we're going to invest that into a stock, into XYZ stock. Okay, so we're going to take 100 and we're just going to say it's $100 a share. And maybe we'll say $100 a share. So now we have a credit. All right, so now we get $900 here. All right, and we got $100 here. So we still have $1,000 of assets. Does that make sense? So we start with $1,000 in our demand deposit account, checking account. We debit $100. A debit is the withdrawing from it, and we're putting that over here as a credit. So these things offset when it comes to basic accounting. So now this goes down to $900 in our demand deposit account, and we have $100 as an asset here in XYZ. All right. So now Mary and Bob are saying, that's great. We have $900 here. We know we have how we get that money. We know for a fact how we get the money. We write a check, we go to the bank, we make a withdrawal, whatever. This money will never go down in value. It will never go down in value because it's in a DDA, a checking account, and it has FDIC insurance. It just won't, unless we pull money out of it. But in and of itself, it will never go down in value. How does this work, though? All right, this is where all the financial models are incorrect. The Francis Maglidani and who Ben Felix cites, who back in the 50s and 60s won a Nobel Prize, if memory serves, in economics. He's in all the portfolio stuff, the capital asset pricing model, CAPM, all the various silliness that comes to stock market valuations. All these guys in the 50s and 60s looked at, and they say this is how portfolio management and construction should work. It's just wrong, man. I'm going to tell you, and we're going to go into this why. And just if you see any modern textbooks, you're going to see Magadani, I can't remember saying, like Samuelson, all these guys. I'm sitting there thinking, I've always wondered this. Like, why don't people get this? It's nuts to me. And what they say is a stock performs by, well, let's go into it. So anyway, all right, so we got this $100 stock right here. All right, so now that's all we're going to focus on. We're going to forget this right here. How do we get paid on this right here? How do we make money from that? Because we invested money with the assumption that this is going to grow more than the liquidity we had in our checking account plus the interest that we're getting. So we're taking a risk and investing that money. And inherently, we are sacrificing $100 of liquidity to buy a stock because we think the stock has more upside potential, even though we don't have access to it, than sitting in a checking account. And inherently, that's why you buy a stock. You buy a stock because you say, at the end of the day, I think that $100 will give me more future money than it will be if it sat in a checking account. That's it. So what is that future money contingent on? It's contingent on 2 things, dividends and earnings growth. All right, earnings is called discounted cash flow. So they're basically saying, we're going to say, what is the discounted value of future cash flows for a stock? Discounted value of future cash flows, or what I call earnings growth and dividends. All right, so regardless of historical context, nothing else matters. We know for a fact if this guy pays a 10% dividend, all right, we're going to have $10. We can do anything. We can put into here. We can put back into here, but we have $10 cash money. We know for a fact if this pays a 10% dividend, we have $10. We made $10 on that $100 investments. Obviously, it's not going to pay 10% today, but I'm just using that for an example. All right, so that in of itself, that's great. We know we have $10. We got to pay tax on that, right? It does reduce the share price by the value of the $10. We're not even getting that. But we know we can bank on the fact that we have $10 of cash flow being redistributed to us because the stock paid dividends. Now, watch this though. What if there is no dividend? What if it's just earnings growth year over year? Discounted cash flows. Projected earnings growth of the company in the stock. What if there is no dividend? It's just earnings growth year over year. How do we get paid? This is fundamental. How do we get paid on this? Think about this. Think about this. How do you get paid on an asset, any asset? How do you get paid on it? Well, you have to sell it. All right. I hope you're seeing where I'm going with this. What do you need on the other side of that trade in order to profit, regardless if you're making money or how much you're getting, but in order not even to profit, but in order to get this money back so you can put it back in your checking account? What do you need on the other side of the trade? You need a buyer. All right, so let's show what I'm talking about here. So we're going to get rid of the checking account for the time being. Every transaction needs a seller and it needs a buyer. And this is where these guys, the academics, I don't understand why they don't get this. They don't. All right, every transaction needs a buyer. What caused a 2007, 8, and going to 2009 insanity of the market? There was no buyers on the other side of the trade. None. If there's no buyers, it doesn't matter what your future earnings growth is. There is no one to give you money for what you're trying to sell. This is what has always boggled my mind. Some call it the greater fool theory in economics. Greater fool theory. GFT. Greater fool theory. What does that mean? I'm going to pay $100 today under the assumption that some fool out there will pay me 110 in the future. That guy will pay me 110 in the future because he thinks there's even a bigger fool who'll pay him 120. It's a Ponzi scheme. I mean, there's no other way around it. At the end of the day, the greater fool theory relies on the fool who's greater of a fool than you to pay you more than what you paid. But at some point, the music stops and there are no fools other than you. You're the greatest fool because you bought that asset at a price that no one else wants. At that point, no one else is going to buy. And that's exactly what happened in 2008 and 9. There were no greater fools. The market had dried up for the buy side. The only way you make money on stocks is if there is a buyer for when you're trying to sell. And so the buyer says, look, I'm smart. I'm going to say this stock, XYZ, has discounted future cash flow of 5%. So I'm willing to pay. So we'll say buyer A buys it for 100. Buyer B says, look, I think the discounted future cash flow is going to be 5%. I'll be willing to pay 105 because the cash flow that it'll make in the future is 5% above and beyond what it's making now. All right, that makes sense. So basic mathematics and economic models and business school, you're like, hey, so I get a $5 profit. Well, that's great. But what if buyer B says, no, I don't care what the discounted future cash flow is. I'm not willing to pay more. Let me get my thing here. Buyer B says, screw all that. I'm not willing to pay more than 80. But even if you could prove the discounted cash flows are 5 to 10%, 20%, it doesn't matter. If buyer B is not willing to buy, it doesn't matter what the discounted future cash flows are. You see what I'm saying? You get nothing. Now I want to go back. So you get if there are no buyers, this could be 1,000,000%. If cash flow growth, it doesn't matter. There's no buyer, a buyer willing to pay. None. And so because that, you are the greater fool. But Josh, it's a solid business. What do you think happened in 2009? We had tons of solid businesses out there. But they couldn't find, there was no liquidity. They couldn't find buyers for what they were trying to sell. And so all the stuff at the end of the day, all the computer models, all the discounted pricing models, all that stuff did not matter because there were no greater fools. This is what's crazy to me. I don't understand how people do this. So let's just go back. The very simple premise of a business. We have Heritage Wealth Planning. All right. I'm the owner. And Josh is also the employee. This is just basic business stuff. I have Heritage Wealth Planning makes $100,000 a year of, we'll just say, profits. All right. So I'm the owner and I'm the employee. And we'll say I'm also the shareholder. Josh is the only shareholder. All right, so we're just going to say, I don't want to say profits. We'll say revenue. That's what we'll say. We'll say revenue. Let's just do that instead. $100,000 of revenue. All right, I pay myself, I don't know, $80,000 salary because employee costs are the biggest expense of a business for sure, salary. All right, so my revenue now, my profit now, all things being simple, is $20,000. All right, so let's just say I have $100,000 revenue. I pay myself $80,000 salary. I got $20,000 of profit. Well, I'm the only shareholder, so I can do, and I'm the owner, I can do one of two things. I can say I can give myself a dividend, pay a dividend to myself, all right, or I can reinvest in the business. Or a combination thereof. I'll go back, dividends and reinvest. All right. So now we fast forward a year, all right, and let's say I don't pay a dividend to myself. I only reinvest in the business. All right, so now we're just going to say I only reinvest in the business. I had my salary, all right, but I reinvest in the business. Now I got a $20,000 asset because I reinvested in the business. I did not take a dividend off that money. I paid myself a salary and I had $20,000 left over and I reinvested. So now I have an asset. It could be in building, could be in software, it could be set in a cash account, a checking account. It does not matter. Now I take on another shareholder. We'll say John. But John's a passive shareholder. All right, so remember I got $20,000 of assets. All right. John says, man, Josh, looks like you kicked butt and took names. Your return on assets, your return on equity, the whole thing. I'd like to invest in some of that in order to recoup a profit later on down the road. But John's a passive shareholder. He's not part of the business. He's not earning a salary. So I got $20,000 of assets. So next year I make another $100,000. Pay myself a salary of $85,000 this year. Got $15,000 left over of assets, of $15,000 of profits. Again, I have the choice, a dividend or reinvestment. And again, I don't pay a dividend. I just reinvest that $15,000 into the company. So now I have $35,000 of assets. But see how I pay myself a salary? Because I am the employee on top of the shareholder. And I'm going to go where this is going here in just a second. Now I got $35,000 of assets. What does John have? Nothing. He's got nothing. Now John could say he could sell his share. What does he get? Corporations, accountings will always do. CPAs will always do it a fair value. They'll say there is a value for the share for these assets here, and that's what John theoretically could expect to get if he sells it. But do you see how so many things could go wrong here? I got 35,000 assets, all right? What if I invested that poorly? Because I'm still the employer, I'm still the employee, I'm still the shareholder. What if I invest that poorly and it goes kaput? On top of that, what if it's in a building? And John says he wants to sell his share back to me because he needs the cash. Where do I get the money to pay him that share? Either I got to find he has got to find another buyer so he can sell that buyer's shares, Or he's got to say, Josh, I need you to pay me. Well, why would I do? I got no obligation to pay him whatsoever. He took the risk as an equity shareholder under the idea that future profits would be such that at some point he'd be able to get that money back. What if that money's in a building? I can't just sell the building. I'm certainly, as a business owner, the business employer and employee, I'm not going to take a home equity line of credit or whatever, a collateral against that to pay John to get him off the thing. It won't happen. John's a passive shareholder. The only way he gets paid is if I pay him a dividend, or if somehow I come up with enough money to buy his shares. But he only gets paid if there is a buyer. He does not get paid if there is no buyer, regardless of what my assets are. This is why I don't understand why people don't get this. Dividends, on the other hand, are assurance that he gets paid something. He knows if I pay a dividend, he's getting paid something. And in corporate, publicly traded stocks, he knows too, if my dividends start dwindling because of cash flow or whatever, he can sell the shares because we're going back, I don't have it up there, to the greater fool theory. He says, the dividends are starting to fall off a cliff. I see these cash flows are going up and up and up from a negative. I mean, these liabilities are going up and up and up. The positive cash flow is dwindling. The dividends are dwindling. Liabilities are going up. I'm going to sell this stock before there is no greater fool. But in this case, the only person who's going to buy my stock or Heritage Wealth Planning is either going to be me or nobody. Why would anyone else go in here and buy John out? Because they're going to say, John, why are you trying to sell? Well, because Josh won't give me any money from the value of the stock of the company. And the other sellers go, why would I buy that? I don't want to put money into Josh's company if I'm not going to get some kind of dividend from it. And John will say, no, but you get a future earnings growth. Well, they say, well, why are you selling then? Well, because I need the money. Okay, but how do I turn future earnings growth into money in my account, into my checking account? How does that happen? It's nuts. It only happens if someone else will want to buy. So regardless of what my price to book is, regardless of what my ROA is, my ROE, regardless of my cash flows, the only way you get paid as a shareholder is one of two ways: dividends and or someone else is willing to buy it from you. If someone else says, I'm not going to buy that stock, guess what? I don't care what your discounted cash flows are. You are not making any money. That's all there is to it. That's why dividends are so critical, because dividends give you, without question, a way, almost like a standings. Like you have sports. You say, okay, the Patriots are 1-0. Next year, 3 straight games, they go on a pretty significant losing streak. You're like, that doesn't look good for the Patriots. And dividends are the same way. It gives you a running total, a running way to examine a company. How is this company generating cash flow in which I can actually receive a benefit of it in order to add to my checking account, or if I want to, increase my shares. It doesn't matter what I do with it. It's on me what I do with it as recipient of the dividend. But I get the dividend, I can spend it, I can sniff it up my nose, I can reinvest in shares, I can buy a bond, I don't care. But I'm taking money out of the stock in order to live on. The only other way that this happens, if there's no dividend, is I have to find another buyer. In this case, with Josh as the owner, I have no reason at all to take care of old John, because I can say, look, John, I made $100,000 in revenue last year. I'm paying myself $100,000 in salary. I got no net profits. Well, I'm living high in the hog because I paid myself a significant salary and I made good money. The company is actually quite profitable before an employee cost, before labor costs, but I paid myself a significant salary, so now I have no profits whatsoever. Does that make me a bad company? It does for John's perspective. Does it for me as the owner of the company? No, because I got paid. Does it add to my asset base? No. Does it matter? No, because I got paid. John doesn't get paid. John's not going to be able to sell those shares because they're going to go and say, we would like to see an accounting of how this company is run. And John's like, man, they're paying themselves salary. There's no profits going back to the shareholders. Josh says, sucks to be you. I didn't want to sell the stock anyway. I needed to raise capital. You're a fool. The greater fool. Sucks to be you. For me, though, I am still living large on a $100,000 salary. I got no net assets to throw back into the company. I wasn't paying a dividend. I don't need to pay a dividend. I'm paying it to myself. That's how it works. Now, will companies do that who are publicly traded? No, they have an obligation to their shareholders. The obligation of the shareholders, though, isn't to find a buyer for the shares. The obligation of the shareholders is to be prudent, to be a fiduciary, to not freaking take profits and give it all to the employees. But that's another problem here too. The biggest cost of a business is labor. So a company doesn't pay a dividend and a growing labor cost. How much is that going to be left to John for discounted future growth? And discounted future growth is what you're saying. John's saying what he expects the value of his shares to be on. Anyway, I know there's a lot going on here. I find it to be incredibly just mind-boggling in the ineptitude of not realizing that dividends are the way you can value a stock for sure. Can they cut the dividends back? Absolutely, absolutely. If they cut their dividends back, we're right back at square one, where we have to find a buyer for our shares. If they increase their dividends, that makes it look more and more and more, what's the word I'm looking for? Like a profitable enterprise, because they're buying, they're increasing their dividends, i.e. they're taking money that they could reinvest in the firm, increase salaries, increase whatever they wanted to do, buyouts, the whole thing. But what they're doing instead is they're taking the dividends and paying me cash where I can go back to my checking account and take that dividend and put it into the checking account where I can actually consume it. That's why dividends matter. It's a running tally of how a company is being run, where I can actually take dollars and spend those. I cannot take dollars and spend them on the discounted future growth of earnings unless there is a buyer to buy my shares. If there's no buyers, there's nothing for me to be had. Hope this helps. Put your comments down below. I'd love to hear your thoughts on this. And again, if you're on the course, I appreciate you being here. All right, thanks now.